Good morning and welcome to the Open here on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us today. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. The Canadian economy technically fell into recession to start this year. First quarter GDP unexpectedly fell, held back by weak business and government spending. That means the economy has shrunk in 2 consecutive quarters. StatsCan says it's the first time for a recession since 2020 during the COVID-19 pandemic. Before that, it was in 2015 amid low oil prices. Laurentian Bank posted weaker than expected second quarter earnings as the bank set aside more money for potentially bad commercial loans. The bank says higher loan loss provisions weighed on overall profitability, with the bank's efficiency ratio also deteriorating significantly. Late last year, Laurentian agreed to be split up and sold, its commercial operations going to Fairstone, National Bank purchasing the retail and small business segment. Shares of Dell are soaring in the futures right now. The pre-market, look at that number, up 33% after the computer maker gave an outlook for annual sales that far surpassed analysts' estimates. Dell says revenue in its upcoming fiscal year will be about $167 billion US, including $60 billion worth of sales of AI servers. Dell's servers designed to run AI workloads are attracting customers from a variety of companies that rent computing, as well as corporate clients and major AI providers. And taking a look at the markets right now, they are up. Dell's driving a lot of that, and also the news out of the Middle East that we may be seeing progress when it comes to a peace deal between the U.S. and Iran, but they're not up as much as you thought, although it's been a run for them. The NASDAQ by 0.13 right now, and the S&P 500 pushing 7,600. It's up by 0.12, both sitting in and around record territory. The TSX, it bounced back yesterday after the hit before, but it was up by about, up into not quite, fourth highest close we had. The high, of course, the record high was on Monday, then a couple of pullbacks, but right now it's still sitting in solid territory at 34,500. Taking a look at oil, and you can see a bit of a pullback, of course, on the news about those negotiations, the talks happening in the Middle East, and WTI for July is off by about 2% and ready to drop below $87 a barrel. I haven't seen that for a little while. And gold, the other one we want to keep an eye on right now. And it is on the way up. It's around 45.52, up by 0.44%. Well, the Canadian economy edged into a technical recession in the first quarter of 2026 as weak business and government spending drove a slight contraction. Let's get perspective on this from Avery Schenfeld, Managing Director and Chief Economist at CIBC Capital Markets. And Avery, thank you very much for joining us. It is a technical recession, but it's pretty close, isn't it?
Yes, we don't tend to actually sort of define a recession until actually a little bit past this sort of point in time. You want to see revised data and so on. For example, we did see that the 2025 growth rate for the year as a whole did get revised up a bit. So you don't issue these declarations right away. But we have seen an increase in the unemployment rate as well. So, this may end up being called a recession at the end of the day. We'll wait and see the final numbers when they come out in a while.
Okay, that the annualized negative 0.1 and the Bloomberg median estimate was 1.5%. That's a big miss. How concerning is that?
Well, what it tells you is that the industry level GDP data that we were tracking got revised a bit. So the pattern wasn't as strong going into this March reading for that monthly number as we would have thought. And so it looked like that GDP by industry series was going to come in at around 1.5%. But with all the revisions and the disappointing March, it actually showed some slight growth, but not nearly as much as expected. And really what this is telling you is that we're still struggling. And we knew that already with what was happening in the labor market, what was happening in the export sectors, with particularly those hit by tariffs like autos, steel, and so on. So it's not a huge surprise the Canadian economy is struggling, but it's certainly disappointing that we've now had a couple of quarters with some slippage here.
And is it the tariffs are really finally biting? Is that what that is?
I think that's a part of it, and certainly that's part of the story going back over the past year is that our export performance has been weak, and we did see that again in these first quarter numbers. Weakness in exports was part of the story. There were other moving parts here. Business capital spending has also been quite weak, and I think that may also be tied up with the tariffs in the sense that if you're worried that your industry could be the next one hit by the Trump administration, you're going to be reluctant to build a plant in Canada if the target market is the U.S. So we've seen weakness on that front. And then there's a whole separate story, which is a made in Canada story, which is the weakness in our housing market. And again, in the first quarter, weak home sales meant that, real estate agents weren't making money. They count in GDP. So we also had another decline in the residential construction component. So consumer spending was one thing that did grow. But elsewhere, it looked like a pretty sluggish report.
And when you look at all those other numbers you were just talking about and then see consumer spending growing, does that surprise you, or are there good, solid reasons for it?
Well, it is interesting, but that consumers are actually digging into their savings a bit. So the savings rate dropped. People were, in other words, spending more, a greater share of the money coming in. And that may reflect the fact that investment portfolios have done pretty well. So people may feel that if they've made money on stocks, for example, they don't need to put more of their money into savings. They can actually spend a little more. It is a bit concerning, though, looking ahead in the upcoming months. We have this squeeze from higher gasoline prices that does suggest that consumer spending might struggle a bit in the second quarter. The only good news we got on that front is that the first estimate of April GDP was a 0.4 gain. That's a healthy start to those GDP by industry numbers for the second quarter. So it may indicate that we're due for at least some growth in that quarter. But, it all adds up to an economy that isn't really where we want it to be. And I would blame the weakness in housing and the trade tensions that are hitting both exports and investment for the major part of that story.
And also, I believe defense spending was off, and that might have thrown this for a loop, too.
Yeah, so these numbers will seesaw if the government orders major defense systems in a given quarter and then the next quarter doesn't, it shows a drop there. So government spending was in general weak as well in the first quarter. I don't think we're going to see that as an ongoing story for the economy, but it did impact these first quarter numbers.
All right, and where does this leave the Bank of Canada? What does the Bank of Canada do with these numbers?
Well, the interesting thing is the market has been pricing in some odds of the Bank of Canada raising rates at some point this year to respond to the energy inflation. And there's really been two blows to that sort of thought. I never joined that view. I thought the economy was far too weak for them to consider that. And this only adds to that. And of course, if we are in fact getting closer to some sort of deal to reopen the Strait of Hormuz, then some of that inflation pressure that the Bank of Canada was worried about will disappear, at least over the next year or so. So I think at the end of the day, the Bank of Canada is going to sit tight here. They're not going to respond to the uptick in inflation from energy prices if that's temporary. And if anything, it does mean that if we get a quick end to this conflict and oil prices come down, there is still room for the Bank of Canada to think about cutting interest rates. My view is they want to wait to see how these trade talks go before they would make that sort of judgment. If we don't get hit by additional tariffs or get some relief from the Trump administration on those that have already imposed, that might be enough to keep the Bank of Canada in a stand-pat position. So our current forecast is no move at all from the Bank of Canada for the foreseeable future. Maybe in mid-2027, the economy improves enough, they could even think about hiking rates, but it's a long way off for now. And I think the market is going to rethink that idea that they could be hiking this year.
Okay, we have to wrap it up there. Avery, but thanks as always for joining us. Appreciate it. Have a great weekend.
Same to you.
Avery Schenfeld is Managing Director and Chief Economist at CIBC. Well, shares of Dell are soaring pre-market after raising its full-year outlook, and it's all about AI. We'll tell you about it after this. Well, shares of Dell are soaring pre-market after the tech hardware company raised its full-year outlook and said first quarter sales climbed 88% on demand for artificial intelligence products. Let's get more now from John Corpina, Senior Managing Partner, Meridian Equity Partners. John, thanks very much for joining us.
Good morning. Happy Friday.
Indeed. I'll take it this week. It's been one of those weeks. Dell is going to enjoy this Friday for sure. What are the numbers? Let's look back. What are the numbers that they posted stand out the most for you?
Yeah, I mean, just look at the year-over-year growth in revenue, 88%, pretty incredible numbers there. And the theme that we're getting out of the Dell report is quite similar to all the other reports that we've gotten, beating on top line and bottom line, outlook positive in the tech sector moving forward. You couple that with the AI headline, you couple that with the government contracts, and we have the president a few months ago saying, go out and buy a Dell. He's pretty much orchestrating publicly what his views and thoughts are when it comes to an individual company like that. So we're clearly seeing that all play out now in front of us. But I think that theme that we're hearing from Dell, again, is the same one that we've heard from the tech sector throughout earnings season here, is that the outlook is rosy in that area for now. Anything touching AI is going to have a positive impact on the stock, and the demand for AI servers and memory space is going to continue.
And this beat, though, was huge. Why? It seemed to catch a lot of analysts off guard. Why? What was it that they didn't see?
Yeah, I think Dell has kind of flown below the radar for quite some time, right? It was a public company, went private, came back public again, and in that gap in time there's been some other names that have really risen above and have been more headline news that's out there. But I don't know, you walk around the trading floor here and everyone's got Dell computers, and I'm sure many of the businesses and corporations out there still use Dell computers. But it hasn't gotten that publicity that some of the other companies have gotten. And now you've got the government spending behind it and the contracts that are being rewarded. I don't know why analysts miss this one so much. I think the bar was set low, and the bar should have been set higher. So I think that's another theme that we see all along here, is that when we get these beats versus what analysts have seen, the analysts have not really been in line where the numbers have been coming out. So that adds an impact positively to stock price, but I'd question the analyst on that. Like, how were they so far off on not just this one, but some of the others?
And judging by its outlook, I think they'll be paying closer attention, because it looks like it's going to be another gangbuster year for them.
Yeah, exactly. Yeah, they're gonna have to really reevaluate their numbers and take into consideration not just the individual company of Dell, but the whole entire sector there. It kind of all rises together. I think the analysts are going to have to really justify their jobs at this point.
All right, let's talk about Costco. Also reporting they had an increase in net sales for the period, beat Wall Street revenue expectations, but they're still off in the pre-market right now.
Yeah, I think, obviously totally different sector and a different battle and headwinds that they have when comparing, well, not that we are comparing, but when we look at earnings season and when we talk about the high flyers in tech. Costco has done well, I think, in this time period where Americans are looking for cost savings, right? We continue to talk about inflation. We continue to talk about discretionary spending. They're going to start shifting and looking more towards these lower price providers. And Costco is one that certainly can provide that. But there's going to be a lot of headwinds there if we're going to continue to tighten our belts, if we're going to continue to have supply chain issues and interest rate conversations. It's clearly going to have an impact on consumer spending. Interestingly enough, Costco, their gasoline sales were up significantly over a similar period of time, showing again that now investors are very concerned about prices at the pump, and they are being selective as to where they go and what those price impacts are. Costco can offer lower prices not only in clothes and sneakers, but also in gas, and we're seeing investors and users gravitate towards that, especially in the gasoline area.
Now with Costco, one of the concerns for some of the analysts was membership growth slowing.
So 4% growth in membership. I think analysts and the company was looking for more coming out of that. So even though, yes, it is a positive, but I don't think that 4% is going to really spark investors to jump into that stock at this point. We're going to have to wait and see if we see a trend now of continuing our higher prices, and if investors and if consumers really shift their spending over to some of these lower cost providers, that would increase membership, but we're not seeing that translation just yet.
All right, and quickly before we go, big picture, everybody's on a run. The NASDAQ, the SPX, all of them 6-day streaks looking to extend today. They might. And 9 week, this would be the 9th up week in a row. Can this continue?
I don't want to. I don't
look
want
into
to
your
sound
crystal
cliche,
ball.
but you can't fight this tape. You cannot get in the way of it. A deal is on, a deal is off. The Strait is open, the Strait is closed. It doesn't matter at this point. I think investors are getting tired of all of that rhetoric. They're going back to the fundamentals. They're looking at the economic data. They're looking at earnings seasons, reports, and outlooks. And if you just isolate that information there, things will continue to look good. Now, it's just a question of, does our geopolitical risks and exposure, does one of those major headlines change overall sentiment? I think it will at some point, but as we are right now talking with the headlines that we got last night and this morning, it doesn't seem like anything is going to derail this market. We've got the U.S. saying one thing, we've got Iran saying something completely different. The market does not care at this point.
All right, we got to wrap it up there, John, but thanks as always for joining us. Have a great weekend.
Thank you. You too, sir.
John Copina, Senior Managing Partner, Meridian Equity Partners. Up next, with big tech earnings season now wrapped up, we'll discuss the reasons data centers are becoming increasingly unpopular with local residents. We're back in a moment. Investors are eyeing the data center build out, and earlier we spoke with Gil Luria, Managing Director and Head of Technology Research at D.A. Davidson. He says AI data center expansion is progressing a lot faster than anticipated.
The economic returns start to pile in for these large companies. They're more eager than ever to build even more data center capacity. That's how we even get into this conversation about data centers in space, is that the rate at which we're building data centers terrestrially isn't enough to satisfy the speed, the demand for AI compute is growing.
Okay, so let's talk about energy and other commodities needed for the build out. What ends up being the biggest bottleneck at this time?
There are several bottlenecks. It starts with municipalities approving the development, then having enough power locally to power the data center, then having enough people to build the data center, the chips. Now, we don't have a shortage of NVIDIA GPUs anymore, but now there's a shortage of CPU and of memory. The equipment to power the data centers is in short supply. And then you get back to the issues that these companies have once they have data centers with those same municipalities that sometimes have buyer's remorse.
Okay, we know we've seen a lot of protests in the U.S., smaller communities who don't want the data centers there. What are the risks you see as putting data centers into some communities?
So at the local level, there's a couple of hazards. One is it's a big draw on electricity. It's a big draw on the water supply. And there's been some reports of noise depending on where the data center is located. So those are the drawbacks. The benefits are that the data center construction creates jobs, and then the data center operations create jobs that are sustainable. And so at the municipality level, that's the trade-off. But then we also have the trade-off at the national level. This is a big drain on a lot of resources at the national level. And some of these AI companies are talking about how their AI models are going to displace jobs. That's not a message that anybody wants to hear. And so at the national level, we're starting to get pushback. Not only are you making these noisy, water, energy hungry facilities, you're also telling us that these very same data centers are going to be why we lose our jobs. That's why you're starting to see so much pushback. You're seeing commencement speakers at universities getting booed off the stage.
Okay, so talk to me a little bit more about cost of living, because you're going to have these folks who are coming into work. They might be from out of community. They're going to have to be trained in certain things to do certain functions at these data centers. Are we looking at a situation where the average community member won't be able to afford things in the community anymore?
Well, the influx of temporary workers, the installers, the HVAC engineers, the architects, et cetera, those are temporary and fleeting. So those may not impact cost of living quite as much as the fact that the engineers and technicians that operate these data centers are very well paid. And therefore, as they become part of the community, they may bring the cost of housing up, for instance. But it would have to be a very small community for that to be material. It actually doesn't take that many people to operate a data center. Takes a lot more people to build it.
Why do you think this is going to become a big issue in the midterms?
Again, the pushback we're getting is from two different levels. One, it's the disruption to many people's local municipality, and then it's that threat of jobs. And the last thing you want to do ahead of an election is tell your constituents that they could lose their jobs to artificial intelligence, to machines, to technology. And I would expect some savvy politicians, especially since we have a lot of degrowth politicians in the U.S., to latch onto this issue and make it a big part of their campaign, especially in the places where data centers have come in and have been disruptive, say Northern Virginia, some parts of Texas, North Dakota, Wisconsin. These are some of the places where data centers have been disruptive, and I would expect some savvy politicians to pick up on that and make it a campaign issue.
Have you noticed a trend when you see the pushback? Is it because there are smaller communities you don't want it? Is it because if they're outside a bigger city, does it tend to be okay? What are you seeing as far as trends to the pushback?
Yeah, the smaller the municipality, the more impact, the more resistance there's going to be at the local level. So rejecting data centers at the local level. The issue of job security is a national issue. In fact, it's a global issue, but it's a national issue in the U.S. where this conversation is starting to ramp up about how this is going to impact the job market.
And I was speaking with Gil Luria, Managing Director and Head of Technology Research at D.A. Davidson. Opening bells are coming up next. Take a look at the opening bells of the NASDAQ F5 ringing the opening bell. IDT Corporation at the New York Stock Exchange getting the honors in celebration of its 25th anniversary of its listing, and Starlight Capital at the TSX. The bell's ringing there to open the market and celebrate the company's new listing of the Global Real Assets Trust. It's time now for the first 15. This is BNN Bloomberg, and trading is getting underway. Let's check in on the equity markets, and no real surprise green today with what we've seen unfold in the Middle East, the optimism and the Dell's earnings report are right now. The TSX, it is up ever so slightly right now, not much, but still in the green, pushing back towards the record high that it saw on Monday. The NASDAQ's pushing up towards S&P 500, pushing up towards 7,600, up by 0.18. The NASDAQ also up, nearing 27,000. It's up by 0.16%. Okay, let's take a look at a couple of some Canadian stocks we just want to take a peek at here. Laurentian, what is it doing right now? Off slightly by 0.64%. It missed on estimates for its second quarter. Missed the average analyst estimate in adjusted EPS, 46 cents versus 73 cents year over year. The estimate was 66 cents. And net interest income, 185 million. The estimate, 182 million. And provision for credit losses, 26.9. This is the big one year over year. The estimate was 14.8 million. And one other one we want to keep an eye on, MDA Space. And it's down now, about 5.4%. It has had a good run, though. Take a look what it's done since, December, and then again since April. That dip, of course, in April, but it's taken off. It's been cut to sector perform from outperform at ATB Capital, and you can see markets reacting. It's down by about 5%, a little more than 5% right now to start the day. And from Uber south of the border, we're joined by Monique Malema from Bloomberg News. Monique, thanks as always for joining us. Some stocks we want to take a look at. AST Space Mobile. Just so much. Space Mobile. I keep wanting to say Space Mobile. Space Mobile. I love it. How's it doing today?
Yeah, so AST Space Mobile, their shares are down this morning after the Blue Origin rocket ended up exploding last night on the launch pad. Blue Origin is a partner of AST Space Mobile and is going to be one of the companies that is launching AST's satellites into space. So with this rocket explosion, that really puts some setbacks in place for AST being able to launch its satellites. Analysts say this could potentially cause long delays, which then could weigh also potentially on AST's earnings if they can't get their satellites into space in the time frame they were expecting, or if they have to look to other partners. So that's why we're seeing their shares trading quite a bit lower this morning, as well as some of the other space stocks.
All right. Next Power. What's going on there?
So Next Power, their shares are rising this morning after the company agreed to buy Prevalon Energy. Next Power is in the utility solar space, but this company that they're acquiring is in battery energy storage and also provides power infrastructure for data centers. And that's kind of the main focus for analysts right now. People are really positive on the news that Next Power is acquiring a company that's already in the data center space. Prevalon has agreements in place with Meta and is also looking to expand to other hyperscalers for their data centers. And this is an area in the energy space that's been seeing a lot of growth and a lot of demand for power for artificial intelligence. So there's a lot of hope that Next Power will be able to move more into this space that's seen growth compared to solar, which has been seeing some declines recently.
Yeah, I was just taking a look at some of the analysts, not one of them really saying negative things about that deal. Okay, Sentinel-1, what's happening there?
Yes, so Sentinel-1, their shares are trading lower this morning after they reported results. Their quarterly earnings did see some beats on a few metrics, but their proportional bookings had some weakness. And analysts are really focused on the guidance. They say that the revenue guidance was a little disappointing. It was lower than they had been expecting, and so they're seeing some weakness ahead. And Sentinel-1 also announced today that they're going to be laying off 8% of the company's staff. So that also points to the company trying to focus more on increasing their profitability. And with all these factors together, that really pressured shares this morning.
All right, Monique, thank you as always for joining us. Have yourself a great Friday.
Thank you.
Monique Malema from Bloomberg News. Coming up, we'll look at the mismatch between bond investors' concerns driving rates higher and the relative lack of fear in the equity market, lifting the S&P to record highs while the war in Iran presses on. Stay with us. The S&P is opening near record highs today as investors remain optimistic that the U.S. and Iran will soon reach a peace deal that will lead to the reopening of the Strait of Hormuz. Our next guest says what's most concerning to her in the market isn't the high valuations or concentrated earnings growth, but the inflation concerns driving up bond yields. Here to tell us more is Melissa Brown, Managing Director of Investment Decision Research at SimCorp. Melissa, thanks very much for joining us.
Good morning.
Your concerns, what's driving that?
Well, I think if we look at the inflation print from yesterday, just the general trends that we've seen in inflation, I think it's reached a point that's sometimes we look at inflation as being good because it means the economy is growing. But at some tipping point, inflation starts to be bad for stocks and bonds. Stock investors really don't seem to be concerned about that right now. Maybe they view this current inflation environment as being very transitory. But bond investors clearly are showing more concern as they're driving longer yields up.
Now, the yields, did they not flatten a little bit, or have they started creeping back up again?
When I looked yesterday, they were still creeping up. They may be flattening, but they're certainly up quite a bit from where they were a month ago, let's say.
And with the inflation, what's a concerning number for you with that?
Well, really anything over about 2%, which is, the Fed's target, and it's the Fed's target for a good reason. After that, we start to see the balance tip towards being, companies can't raise prices, but wages are going up, for example, or consumers are seeing prices higher than they can spend. So they, what we see now, for example, is consumers are spending on, gasoline because they have to, or food because they have to. But I think, many consumers are therefore having to cut back on other areas of spending.
And are we seeing noticeable pullbacks in those other areas?
Well, what's interesting, and my theory is that right now we're not really. If you look at, the earnings picture, earnings were very good for the first quarter. I think you have this stock market wealth effect where, people who are invested in the stock market, which is by no means everyone, but those who are have seen really big gains. And so they're probably spending, right now their spending may be making up for this spending that's not coming from people who are otherwise, using their money for necessities. If the market keeps going up, we could see that continue. But, I think that's a kind of precarious way to be generating earnings.
And with that, just looking at the consumer sentiment index, it's a record low, 44.8.
There's a little there. Well, I was going to say a little bit. There's probably a lot of disconnect between what consumers are saying in these consumer surveys and what they're doing in terms of spending. And that's kind of why I think we've got this, spending, pretty freely on one part of the economy, but the inability to buy things other than necessities on the other. And I think that's where that lower consumer sentiment is coming from.
And so where do you see opportunities with this? Is it still in the U.S.? Is it emerging markets?
Yeah, certainly outside the U.S., we've seen emerging markets have probably had the best performance if you look at, the global emerging markets. But we have seen a number of non-U.S. markets actually outperform the U.S. The U.S. has been so strong, so these other markets are particularly strong. They may have farther to go because they've lagged for many years before this year. And so it does seem that in the absence of a global recession, which is going to, sink all boats, I think that there probably are more opportunities outside the U.S. as compared within the U.S.
And are there any thoughts we just saw some numbers here in Canada that technically leaves us in a recession, but global recession, are there any indicators that are pointing toward that?
Not that we've seen so far. And so I guess that's the good news. GDP growth in the U.S. has been strong, so that's going to, signal for the rest of the world, where growth might be. But, we have this war going on. We have oil prices, even if they're coming down, are still substantially higher than they were 2 months ago, 3 months ago. And so, you've got some of the signposts that may drive recession in the future. We're not seeing that yet.
All right. And you mentioned about the war, the impact on inflation. Where are some other areas where maybe people aren't thinking it's having an impact, but it's being felt?
Well, we're seeing it's not just oil prices, it's many different commodities that have to go through the Strait of Hormuz. So if you look at urea, which you need for fertilizer, or aluminum, there are many commodities that are, kind of being choked off and driving their prices. In fact, those two, their prices are substantially higher, probably 50 to 100% higher than they were 3 months ago. If you can't get fertilizer, it's going to start to hurt agriculture. You can't get aluminum, it's going to hurt building. So we're not seeing that yet, but there is the potential. And I think it's going to take a while for those prices to come down, even if they do open the strait tomorrow. I mean, it's not going to just all of a sudden everything's going to open up and ships can start going through.
All right, Melissa, we have to wrap it up there, but thank you very much for joining us. Have a great weekend.
Thank you. Bye-bye.
Melissa Brown, Managing Director of Investment Decision Research at SimCorp. Well, yesterday on Market Call, we were joined by Greg Newman. He is Senior Wealth Advisor and Portfolio Manager of Newman Group Scotia McLeod. He was covering North American equities, and his top picks were Definity Financial, Stantec, and Microsoft. Today on the show, we have Brianne Gardner. She is Senior Wealth Manager of Velocity Investment Partners, Raymond James, and we'll be taking your questions on Canadian and U.S. large caps. Just ahead, SpaceX is currently targeting a valuation of at least $1.8 trillion in its initial public offering. We'll have more after the break. SpaceX is currently targeting a valuation of at least $1.8 trillion in its initial public offering, according to people familiar with the matter. Bloomberg News reported in April that SpaceX was aiming for a valuation above $2 trillion. The target is settling lower after consultations with advisors and investors, the people said, asking not to be identified as the information isn't public. Matthew Bloxham of Bloomberg Intelligence has more.
SpaceX has lowered its valuation target to at least $1.8 trillion. Elon Musk's company seeking to raise as much as $75 billion, which, of course, would make it the biggest IPO of all time. Let's bring in Matt Bloxham then from Bloomberg Intelligence. Matt, is this a negative signal, or is this a kind of usual run-up to an IPO? You have the adjustments, you get the feedback, and maybe you adjust lower, but doesn't necessarily tell you a negative story, or does it?
Yeah, no, I think it's more that, they're kind of bouncing back feedback from key stakeholders. It's a bit of a game of cat and mouse, isn't it, an IPO? You want to maximize the valuation for the selling company, but also you want to leave a little bit on the table for buying investors so that when it lists, you get a bit of a pop, everybody's happy. And, how far between those two kind of benchmarks you stray is kind of the art of being a banker, I think, on an IPO. And also, they haven't even started the roadshow yet, so I think that's going to start next week. Potentially, if that goes down well, then you could see that valuation kind of move back up towards the kind of $2 billion mark.
Yeah, it will be the largest IPO in history.
Yeah.
Pretty remarkable.
Yeah.
So back in February, I remember the big story was that SpaceX incorporated XAI into the full structure.
Yeah.
How is that going to benefit or even possibly detract from the business? I mean, how should we be thinking about it?
Yeah, I mean, I think when you look at the way they're pitching this business in the S1, it was an essential part of pulling the story together, because really, this is not just about rockets. It's not just about satellite broadband. It's about this kind of multi-decade view of creating gigawatts of data center capacity in space, and then creating a million plus kind of permanent establishment on Mars. And so you can only do that with all of these things coming together.
Right.
Matt, defense and defense contracts and contracts with the Pentagon have been significant in terms of revenue driver for SpaceX. There's a review going on, I understand. What is the nature of that review? How significant could that be for the company?
Yeah, that's right. It's the committee that looks at kind of foreign investment in U.S. companies, obviously given SpaceX's involvement in NASA and other government agencies, particularly military. I think there's inevitably always been a lot of scrutiny about SpaceX as a partner, but clearly a lot of focus on on who are the investors in SpaceX. If they're foreign investors, does that potentially create a risk in terms of influence over the company and maybe the sharing of secrets that the US would not want to be shared? Now, for me, the bigger issue here is how much does the US trust Elon Musk? Because Elon Musk will control 85% of the business. So ultimately, it's what's he thinking and who is influencing Elon Musk. I think that's really the most important question.
The same US government he was an advisor for.
Correct.
Around the time of Doge.
Yeah.
Okay. Let me ask you about SpaceX and the influence the IPO might have on the other big one, which is Tesla. Is there going to be a read across?
Well, I mean, actually, we were talking about this before we came on air, and at some point, will Tesla get rolled up into SpaceX AI too? And I think there's certainly a lot of expectation in the market that that is coming down the road. Because Tesla is not really so much an EV business now, moving more into kind of robotics, involved in the terafab kind of chip production kind of capability. So, there are very strong links between the businesses already. I think it definitely wouldn't rule out the fact that at some point when the conditions are right, that you could see a transaction happening.
Interesting.
Drivers in some parts of the country, including the Greater Toronto area, woke up this morning to some of the lowest gas prices in the country, and some that we haven't seen in more than a month. But it's just part of the latest fluctuation as uncertainty drags on in the Middle East. CTV's BC Bureau Chief Andrew Johnson has more on the dip, how long it may last, and why drivers on the West Coast aren't getting any relief.
Varun Sharma is spending $500 per week right now gassing up his cab.
Still lucky I'm driving hybrid, but it really hurts.
But after months of eye-popping prices fueled by the war in Iran, drivers in many parts of the country are getting a bit of a break.
Finally, a little bit of good news when it comes to filling your tank.
Drivers in Toronto were greeted this morning with $173.9 on the sign, the lowest price since April. The reason? A drop in oil prices over optimism the U.S. and Iran are close to a deal. And issues at refineries in the U.S. Midwest that supply Ontario have now been cleared up. As drivers in many parts of Ontario and Quebec revel in this dip on the gas price roller coaster, here in Vancouver, people are still paying on average well over $2 per litre. In fact, as prices fall back east, they're actually rising on the West Coast. What gives? Experts say it's now BC dealing with refinery trouble. A disruption in California coupled with Canada's highest gas taxes have forced people at this station to cough up $2.14.9 per litre.
How much does it cost to fill your tank?
Well over $100, like 130, 100 probably.
Finally, what Gas Buddies Patrick DeHaan calls the million-dollar question, where people are paying less, how long could it last?
100% contingent on what comes of these negotiations between the U.S. and Iran. There probably has not been such a major impact to supply in my career, exceeding 25 years.
It's no million-dollar answer, but the one Canadians will just have to live with. Andrew Johnson, CTV News, Vancouver.
Coming up, we'll zero in on the stocks that actually make money with John Ehrlichman. That's after the break. Okay, companies that are great at making money are often great stock picks for investors, but finding them involves more than just reviewing earnings performance. BNN Bloomberg contributor John Ehrlichman has a new story about that on our website. John hosts the Ticker Take YouTube channel and podcast, and he joins us now with more. John, thanks as always for joining us, sir.
Good to see you, Roger.
I think we all like stocks that make money. Define what is a stock that makes money to you?
Well, it's funny, we often look at earnings. We cover earnings season. We look at profitability in any given quarter, and that's a great determination on whether a company is making money. But it's not the only determination, and sometimes it's actually misleading because it's not the only way that companies get a return. Obviously, running your business and generating a profit is important, but the reality of public companies, Roger, is they're getting capital from all sorts of areas, including to finance their business, right? They're going to the stock market, the bond market, they're taking capital, and oftentimes they are judged on how they allocate that capital. Warren Buffett has a favorite tool called return on invested capital, ROIC. And David Driscoll, who we spoke to in the latest episode of Ticker Take, loves ROIC as well, because it really gives you a sense of how well companies use the money they have and what they've got left over at the end of the day to do great things with, either in the business or to reward investors. And it's funny, Driscoll, who's been on BNN many times over the years, he used to work in the bond rating industry, and companies would come in and they'd try to prove their ROIC worth to get a good rating. And he thought, that could be a good measure for stock analysis, and it's proven to be a great one for him.
And he did, and Warren Buffett did all right with that. Okay, so how is David done, and what is he liking?
He's done really well over the years, and he's proud that in a couple of cases, he's actually been ahead of Buffett on a couple of Buffett picks. Let me give you a few examples that came out of our conversation. I mean, there were 10 in total, but let's use the AI and tech boom. So ASML, we don't talk as much about it. It's a European chip equipment player, but as the AI boom continues, the AI chip makers will be coming to ASML. It gives you some diversification, according to Driscoll, because they're European-based and they're excellent stewards of capital. Staying with tech, you got a company like Lam Research. Same kind of diversification play in that they've got a lot of customers in Asia, which he likes, but they also have a good track record when it comes to doing great things with the money that comes in. And then a company that actually Berkshire and Driscoll have in their portfolio is Chubb. People might know the name. They're in the insurance game. They're really good at not giving away all their money to all the insurance claims, and every dollar that they're able to keep, obviously they can do more with that. So those are a few examples.
All right, John, we got to wrap it up there, but thanks as always for joining us.
Thanks, Roger. Thanks.
You can find John's full story on our website as well as the Ticker Take YouTube channel and podcast. Up next, where to put your money as markets keep hitting new highs and valuations look stretched. We'll have a few picks after the break. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Technically, the Canadian economy is into a recession to start the year. First quarter GDP unexpectedly fell, held back by weak business and government spending. The economy is now contracted in 2 consecutive quarters, albeit by 0.1 and 0.1 both times. StatsCan says it's the first technical recession since 2020. That was COVID-19. Last one before that, 2015, amid low oil prices. Laurentian Bank posting weaker than expected second quarter earnings as the bank set aside more money for potentially bad loans. Laurentian says higher loan loss provisions weighed on overall profitability, with the bank's efficiency ratio also deteriorating significantly. Late last year, Laurentian agreed to be split up and sold, with its commercial operations going to Fairstone Bank, while National Bank purchased the retail and small business segment. Bloomberg News is reporting that Chinese-made EVs have started to arrive in Canada. According to the report, a vessel carrying a small number of Chinese-made Lotus luxury cars departed Shanghai and is now at the port of Vancouver. The cars will be the first imports under a deal that allows up to 49,000 Chinese EVs in a 12-month period at a lower tariff rate. And taking a quick look at the markets, and you can see the TSX back into the red after starting the morning up. It's pretty much a wash right now and still well above 34,000. And south of the border, gangbusters again today, looking for a 9th straight week of gains, 7th straight day for the S&P 500. It's up by 0.44 right now. The NASDAQ also same situation, both of them well into record territory. NASDAQ up by 0.6, led by Dell with that good, strong earnings report. Okay, markets are at all-time highs, driven by the AI boom. So the big question, can you still find investment opportunities when everything looks expensive? David Sekera, Chief U.S. Market Strategist at Morningstar, has a few picks for us right now. David, thank you very much for joining us. A reason to smile this morning, I'm guessing?
It's one of those things that always feels good to be in a market like this, but at the same point of the time, I got to note we're getting very close to, our fair value. So I think investors also still need to temper their expectations, going forward. Yeah, I still think there's a lot of volatility left yet to come thus far this year. And at this point, I'm actually a better seller of growth, specifically tech and AI names. On the March 30th episode of The Morning Filter, that's our weekly podcast, that's when we had noted that it was a good time to move, out of value into growth, tech and AI. And the movement that we've seen since then tells me it's actually time to go back to that barbell strategy, start taking some profits from growth, tech, AI, and move it back into value.
All right. And so where are you looking then for that value?
Well, we've got a couple of different value picks. I mean, the first one I would highlight is Lockheed Martin. It's a 4-star rated stock, trades at a 17% discount to fair value, has an attractive dividend yield at 2.6%. It is the most undervalued of the stocks, according to our evaluations in the defense sector. I mean, overall, there's just a long tailwind behind defense right now, unfortunately. So we're still seeing increasing spending coming out of the U.S., Europe, the Middle East. When I look at the valuation here, we're looking for over a 15% compound annual growth rate for earnings over the next 5 years, yet the stock's trading at under 18 times this year's earnings and only 15.5 times next year's earnings.
So seeming solid right now. Bristol Myers Squibb's another one you have your eye on when it comes to value.
It is. And this is one where I think really the story here is we think the market is just underestimating, their R&D, underestimating their pipeline. Right now, very conservative estimates, and it's still undervalued. 4-star rated stock, almost a 20% discount to fair value. We're only looking for earnings growth of a little over 5% on average over the next 5 years. Stock trades at 9 times 2026 earnings estimates. So in this case, any of those drugs, come to fruition, we're looking for, more data coming out later this year. That's one where I think you could actually see that stock rally pretty quickly on that type of news.
Okay, and Lowe's.
4-star rated stock, 16% discount, 2.2% dividend yield. What I really like about this one, talking to our analyst team, is the company's really just still in the early stages of moving more into the pro segment. That's been a very lucrative area for Home Depot over the past couple of years. So we're looking for strong earnings growth, coming from that area. A lot of pent-up demand from low levels of, housing turnover. So we're just looking for that aging housing stock, really to provide that long-term tailwind as people are, renovating their homes. Another one where I think we have, relatively conservative, estimates. We're only looking for 4.5% top line growth for a compound annual growth rate over the next couple of years. Only looking for 7.5% earnings growth, but yet the stock still models out very undervalued at today's levels.
Okay, and we've got a barbell, so we're going to do Arms Day. Want to balance it out. Growth and tech. Microsoft is the first one that comes up for you.
Yeah, it's a 5-star rated stock, so that's our highest rating on a risk-adjusted basis. Stock's at about a 30% discount to fair value. And when I look across the tech space, we think this one really has one of the best combinations of providing, stability from their subscription based business, still has a lot of upside potential linked to AI. And if you look at their portfolio overall and look at their businesses and how they fit together, we think it's going to provide them with a good natural balance of no matter how AI plays out, they've got upside in their different businesses, whether it's with, Azure and Copilot, their investments in chat and, Anthropic, or if, AI isn't what everyone expects it's going to be, that, traditional part of their business still has a lot of upside potential. So again, one with that good natural balance. Taking a look at revenue, we're looking at a 5-year compound annual growth rate of 15%. Our compound annual growth rate for earnings over the next 5 years, 17%. Currently trades under 25 times our estimates for this year, only 22 times next year. Historically, I think this is a stock that usually trades between 30 and 35 times. So we think the market's over discounting, the disruption that AI might impose upon this company.
All right, and another one, Broadcom. What are you liking there?
Yeah, so when I'm looking at AI investments specifically, I really want to stick with those companies that we think are at the forefront of artificial intelligence technology. Personally, I would steer clear of a lot of these, commodity tech hardware companies that have been soaring over the past couple of weeks. To some degree, you know what? I've seen this story before. I know how it's going to end. I think it's just a matter of how overvalued do those stocks get before we go through some sort of, correction in that area. Broadcom, we're looking at an increase in their AI chip sales of, over 60% over the next couple of years, seeing a lot of growth being driven by, not only Google, but ramping up new customers like OpenAI and Anthropic. Our 5-year forecast for revenue growth here, over 37%. We're looking for over 40%, earnings growth. Trades at 32 times, this year's earnings, but that drops all the way to 21 times based on our forecast for 2027.
And Amphenol and Salesforce are the other two that you're liking. I just want to get your thoughts on a couple others though that aren't in your picks. Costco coming out with its earnings report. What did you see in there that stood out?
This is another one. It's almost kind of like what we saw out of Walmart. I mean, very strong fundamental performance. In this case, their top line was up 11%. I mean, half of that was driven by an increase in same-store sales of 6%. A little bit of an offset. Their gross margin did compress, about 21 basis points. But in this case, we think the stock is just way overvalued based on our longer term estimates. We're looking for compound annual growth rate over the long term of, only 10% for earnings. That's really about a third of that coming from an increase in same store sales over the long term, new store ads, a little bit of margin expansion. But this stock trades at almost 50 times our 2026 earnings estimates. I mean, that's a lot more expensive than a lot of these AI stocks. So I think we're just seeing a pullback in the marketplace today, more on valuation than necessarily performance.
And about 30 seconds, the gap. What your thoughts there?
Yeah, I mean, pretty weak line, only 2% same store sales growth. The Gap brand, pretty mediocre performance. Unfortunately, lackluster performance at Old Navy. I mean, Athleta, their same store sales down 11%, compression in operating margins. So I think this is one where, it may be attractive for long-term investors, maybe a slight overreaction here in the short term, but I think you really need to believe the turnaround story if you're going to invest in Gap today.
Okay, we have to wrap it up there, David, but thanks very much for joining us.
Well, thank you. Appreciate it.
David Sequeira is Chief U.S. Market Strategist at Morningstar. Up next, Canada slips into a technical recession for the first time since the pandemic. We'll break down what dragged the economy down and where it goes from here. Stay tuned. The Canadian economy edged into a technical recession in the first quarter with real GDP falling. Economists had been bracing for a 1.5% gain, so the surprise miss comes as U.S. tariffs keep squeezing businesses. Joining us now to make sense of it all, Claire Fan, senior economist at RBC. Claire, thanks as always for joining us.
Thanks for having me, Roger.
Okay, you called for a Q1 growth to turn positive. I think everybody did. It's a big miss. What happened? How did we miss by this much?
Right. So unlike sort of the contraction that we saw in the fourth quarter of 2025, this particular, GDP really in real terms was pretty much unchanged. A lot of it, where the softness unexpectedly came from weaker business structure spending. So these are, for example, commercial buildings, railways, et cetera, and major renovation projects. And on the government side as well, there was a fairly large sort of decline in their spending on weapon systems, so defense spending as well, even though it's still historically pretty elevated. So I think those two things were sort of the surprise factor on the downside that really dragged the so-called final domestic demand component down. To your point, on the export side, we're still seeing negative impact really of U.S. tariff really impacting auto exports to the United States, even though we've seen a huge imports as well, mostly just tied to precious metal, to be offset by a huge run-up in inventory. So I think, again, back to the consumer side of things, which is really the last component on the expenditure side of things, we're still tracking a lot of resilience there.
Okay, let's go back to the businesses for a second. The hesitation on spending, is that tariffs that's doing that, or concerns about the economy?
Yeah, I think that definitely, just rising uncertainty due to the economy. A lot of this, where most of it again, is coming from factors that are outside of Canada, because again, what we're seeing repeatedly throughout 2025 is resilience within domestic spending. So some of these sort of declines in terms of business investment, although it has been weak pretty much for the last decade or so, has more to do with external factor. Number one is tariff, like you mentioned. Number two is the fact that, a lot of geopolitical headwinds are just escalating right now or persisting much longer than what we had initially expected. Oil prices, which are a key input cost when it comes to fuel costs to businesses, they're still quite elevated at this moment. So I think a lot of businesses are probably just holding off again in terms of not putting forward that investment dollar that they otherwise would have.
All right, and now with the government, the drop off, is that a permanent thing, or is it something that just didn't happen this quarter?
I think the key thing here is to note that the defense spending number, especially on weapons system, is still historically very elevated. It's still, as a share of GDP, 3 times what it was historically. So it's a bit smaller, but that's just on a relative term comparing to pretty solid spending in 2025. So hardly anything, a big change over there. Still pretty resilient spending in defense.
All right, and then the other one you mentioned, household spending actually rose 1.5%. But savings are down, and it sounds like people are digging in. And are they picking and choosing where they're spending?
That's a great question. And that is by far, that's the key question moving forward as well. The longer oil prices and gasoline prices stay high, really what we're watching for is the component of household spending that account for half of the economy on the expenditure side. And so far as April goes, which is the first sort of month into the second quarter, and also sort of the second month that gasoline prices have persisted at pretty elevated levels, we're still tracking some signs of resilience of households, mostly, like you said, dipping into their savings rate. We did see savings rate fall again to 3.5% in the first quarter. And for some lower income households, potentially utilizing personal sort of credit cards, other debt to really spend through this initial period of higher gasoline prices. But that is the key question mark going forward, is just how much of this so-called demand destruction is going to come through. So our estimate is that currently households on average in a month, each Canadian household is spending about $75 to $100 more just on gasoline prices. So it's getting to a level where it can become pretty uncomfortable for a lot of lower income households. So far, no significant signs of demand destruction. Even back in sort of the Q1 data, which of course only covered part of sort of the elevated gasoline price period, we did see pretty solid spending again on services. We saw a pullback in auto spending, and that's something discretionary. So perhaps some weakness already seeping through. But again, that is sort of one thing that we will be watching very closely moving forward.
All right, and technically this is a recession, but it was like I think it's 0.1 and 0.1 the 2 quarters. When they take a second look, any indicators that might get revised up into either zero or into a positive?
Right. So this is the thing. And the other thing is also that, when we do look at GDP data from an economist perspective, there is the expenditure side of things that fell slightly, like you mentioned. But there is also sort of the income side of things, which is the production-based expenditure data. So those two don't really reconcile all of the time, but usually historically the gap is pretty small. It just so happens that the past 2 quarters we've seen pretty big gap in these two set of quarterly statistics. So on the sort of income side, GDP actually grew on a quarterly basis. So that's also something to keep in mind. But definitely past trends in terms of GDP, we've seen consecutive upward revision in GDP components. Now, I can't really point to exactly which component over there that could be revised higher this time around, but certainly if that trend were to extend into sort of a first quarter statistic, it could definitely tip things into a small positive, if anything. So I think down to the bottom, what you're getting at is, will we characterize this really as a recession for the Canadian economy? And I think we're just not quite there yet. Again, some of the resilience that I pointed to when it comes to consumer spending on the household side, as well as sort of pretty resilient, again, government spending still, are all sort of signs that underlie some amount of resilience in the Canadian economy, despite the gloomy headline numbers.
Okay, Claire, I always appreciate your insight. We have to wrap it up there. Thanks very much for joining us.
Thanks for having me.
Claire Fan, senior economist at RBC. Up next on the radar with Andrew Pyle, we'll see why Celestica is beeping for him. Time now for On the Radar, and to tell us why Celestica is showing up, we were joined by Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy.
So Celestica is in the AI business, basically specializing in switches that are going to go into data centers, right? So they partner with the likes of AMD, they partner with the likes of Intel. Well-positioned company. The stock has been trading off, right? So this is a company that's actually broken the trend when we look at some of the other AI blockbusters in the last few weeks. Stock trading now below $500. So to me, this is a stock that's, for a Canadian stock, is really well-positioned. And one of the new things that they're going to be getting into with their partnerships with AMD is optical bundles or optical switches that will allow more efficient transmission of data, which is where we're going to go to next, right? Because we can build out the data centers, but we're still based on copper and everything else. Optical, I think, will be that next step forward. And Celestica, I think, is well positioned to take part in that.
Not concerned that it might be another fiber optic from Nortel, something like that?
No, we try not to think about those.
We try not to think about those
We try not to
things,
think about those things. No, I don't think so. I think, again, I mean, now, I've been on the show many times before where I said, are we getting carried away in terms of what we're expecting out of AI? To some extent, maybe. But for a company like this, which might actually have its hands in a newer technology in terms of switches, I think actually that will compensate. So yeah, I think this, for investors who are saying like, I wish I'd bought Dell yesterday.
Yeah.
You know, those types of individuals can still probably find some value out there in companies, and surprisingly a Canadian company, that just might have that niche that could provide some growth opportunity in the stock.
And you know, where it's up, what, 200% almost for the last year?
Yeah, it's,
Still
I mean,
room?
you know, we talked about Dell before. 3 years ago it was $45 a share, right? And now we're north of 300. So yeah, there's a lot of companies that we can look at that are up, you know, exponentially. But the stock has come back in the last few weeks and might be giving us that opportunity.
I was just looking, and they're building they're building a center down in Fort Worth, a facility down there to try and keep up with demand.
Well, exactly. I mean, this is a Canadian company, but it truly is a global multinational company at the end of the day. It has a footprint in the States. It has a footprint in Europe and Asia. So, you know, you're not just buying something, we're making stuff in Canada and hopefully someone will buy it. They are well positioned in the areas, to your point, where we're seeing that demand and we can't keep up with the demand, at least today.
All right. Cameco's next. What's going on there? What do you like?
Cameco's the same story, slightly different. How do we power the data centers, right? And as we've seen, data centers are increasingly looking towards small modular reactors, nuclear power, well, everything, because there's a shortage of energy to power these mammoth buildings. Cameco is going to capitalize on that. It's going to capitalize on countries around the world now that are converting back into nuclear. Think Germany, which, you know, basically jettisoned
shut down pretty much everything.
Its nuclear infrastructure, now being forced to go back to that. And the stock has shown strong performance. A lot of people think maybe it's a little bit overvalued, Roger. I think this is a demand story that continues for quite a while.
And not worried about, I mean, because it's 10-year build-outs for nuclear, even for these modular reactors. It's a lot of work, it's a lot of planning, and not concerned that things may change and people start scrapping those ideas?
Well, you know what? If you could tell me the Iran war is going to be over tomorrow morning, I'd say,
it's going to be over
maybe,
tomorrow morning.
Right? Thank you. The thing is, the Iranian war has basically told us that, look, we've got some major supply issues.
Yeah.
We cannot be as confident in the supply of traditional energy sources as we once were. And that is not going to go away tomorrow. It's not going to go away in the next year or two or three or four. And so I think countries around the world and companies are going to say, look, it could be a 10-year build-out, but if I don't start now, then 10 years from now, I could be in a worse situation than I currently am. And so therefore, 10 years, fine. I'm going to start today, and I'm going to need some uranium to power the plant. So.
All right. Tourmaline.
Tourmaline, again, we've had this in our portfolio for quite a while. As we've talked about in the show before, Canadian energy company, 80% of which is a natural gas play. Why do we like natural gas? Well, again, let's go back to the Strait of Hormuz.
Yep.
What's your energy supply line look like now for liquefied natural gas? And we look at gas prices, when we look at Canadian companies, Roger, and you know, gas prices are up actually quite a bit in the last little while. They're still lower than what we can get in the global markets. And those are the markets now that Tourmaline are starting to supply into. So they're getting that added benefit of, you know, I don't have stuff going through the Strait, but I've got the stuff that people that are not getting the stuff from the Strait want to buy, and I'm getting that extra price increase. So we like it for that. We like it for the dividend yields. And again, it's one of those things that, you know, this is not going to be over in the next few months.
Do you think we have the political will here, though, to up that with the natural gas and oil and just in general? I mean, we're seeing it. It's been some interesting conversations over the last couple of weeks.
You and I talked about this last time I was on the show.
I think it's
every time
I think this is a conversation.
No, I still believe deep down as a country we've got the political will to do it. Is it smooth sailing? No. Do we execute the way we should be? I mean, if you and I were just running this, we'd probably do it a little bit differently. But I do believe that deep down we do have that will. And again, the market's there. So you either participate in this, or you basically leave cash on the table tomorrow. And I think as a country, it's kind of a mistake to leave cash on the table.
Well, I mean, and we really, Carney has said we are an energy superpower. I mean, between oil and also nuclear. I mean, we are still one of the leading countries when it comes to nuclear.
We are. I mean, it's not a fallacy, right? I mean, we are, and I've said this many times. I mean, you can have a tanker stuck in the strait, or you can have pipelines that are getting product to the world that are willing to pay very good prices. I mean, airwaves say all over how Brent crude has collapsed. It's the worst decline since 2020. Yeah, we're still not north of $90. Yeah. We were $50, $60 a little while ago. So I'll take that price. I'll take the worst decline since 2020. Thank you very much. Right.
No, it's Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy. Coming up, we'll speak to a government affairs and trade specialist about the state of U.S. and Canada free trade negotiations. That's after the break. Canada's economy is now technically in recession after the GDP shrunk in 2 consecutive quarters. First quarter GDP dropped because of weakness in resource extraction industries and in construction activity. The results fell well below the growth forecast of 1.5%. StatsCan says it's the first recession since the 2020 COVID-19 pandemic. Apotex has filed for an initial public offering in Toronto, setting the stage for one of Canada's largest stock market debuts in recent years. Bloomberg News previously reporting the company could raise up to $1 billion through the offering. The generic drug maker says the IPO will include newly issued shares as well as shares sold by controlling shareholder SK Capital Partners. The Bank of Nova Scotia has agreed to purchase Maple Financial Holdings. It's the parent company of MapleMark Bank, a commercial bank operating primarily in Dallas. The terms were not disclosed. Scotiabank says the acquisition supports its strategic focus within North America and says the move will allow it to offer deposit insurance to clients. And a quick look at the markets. You can see the TSX has taken a turn since it first opened just an hour ago. It was in the green, and now it's dipping into the red pretty solidly, off by about 0.23%. Now going the other way into record territory, the S&P 500 south of the border up by a quarter, and the NASDAQ is up by 0.22 right now. The Canada-United States-Mexico Free Trade Agreement is coming up for review on July 1st. The U.S. has begun bilateral talks with Mexico on the review, but not yet, with Canada raising questions about whether the negotiations are advancing as they should. Our next guest has been actively engaging with U.S. senators on trade issues and says sentiment has shifted in a less favorable direction for Canada. Let's get more from Jacques Shore, the Government Affairs and Trade Partner at Gowling WLG. Jacques, thank you as always for joining us.
Thank you, Roger. Good to be with you.
Always appreciate you joining us and love your opinion on things. And you're in the middle of all this. Why this concern right now?
Well, I think I want to be more positive, actually. And I think that it's important at this point, especially after the visit yesterday to New York at the Economic Club by our Prime Minister. I think that, look, we all recognize that CUSMA is certainly the foundation of our economy. And in many ways, it's more than just a trade agreement. So we have to focus on that entirely. And I think all hands are on deck to address it. And I guess I would say if I would have had this interview several days ago, maybe my view of it would be a bit different. one of the things I think is to recognize that while we maybe aren't getting some of the attention that we would want in the White House to address Kuzma, I mean, they're busy dealing with other countries on trade agreements as well. So there's a bandwidth issue that I could see there. But I do think that at this moment, with the visit of the Prime Minister in New York yesterday, there is a bit of a change of approach. There's a recognition that we have a lot to offer the United States, speaking obviously to the investment community there, recognizing the value that we offer. I think we're now at that moment, if I could say, that seven inning stretch to actually move forward. So I'm feeling a little bit more positive.
So what did the Prime Minister say or do that is, I mean, we've been selling that and trying to tout that for a while now. What did he say or do yesterday that maybe hit home?
Well, I love the fact that he actually, referred to the importance of us, being independent, recognizing that we've relied very much on the United States, through these decades in many ways, whether it's defense or otherwise, but also demonstrating that if we are somewhat independent, that's an advantage also to the United States. But at the same time, making it very clear, as he put it, Canada, essentially the North strong and free to help for us to be able to help America be great again. We're obviously an integrated economy. We obviously have a supply chain that values very much how we've approached our issues with respect to Kuzma. And look, there are irritants. There's no question. And so we have to listen. We have to understand a bit more that, those irritants do bother the United States. And how can we accommodate? How do we actually moderate and address those issues? And I think that over the next period, especially as well with a comment made yesterday by Dominic LeBlanc, where he's about to head to Washington, D.C., I think what we should do is think positive. I think that sometimes helps us in moving these issues forward. But look, let's be real. We are going to be in a very difficult moment if we reach July the 1st and we suddenly find ourselves in a position where we're going through a review. Businesses, industry does not like unpredictability. We need certainty. And I think that's as important for the United States as for us, because there are, and recognizing in Congress today, there are business leaders in the United States knocking on those doors and saying it is important for us to move forward. When we think about the supply chain, when we think about the way in which we obviously deal with critical minerals, manufacturing, agriculture, look, we can go back to the 1960s when we arranged and integrated through the auto pact. Now, auto is another area completely, but I think that right now, sending those messages, working with Americans to share those points are important. And yesterday, how nice it was to hear Pete Extra, U.S. Ambassador to Canada, offer the point of something positive in light of what our Prime Minister said.
And I just want to go back to what you mentioned about irritants. What are some of the irritants, do you think, and how much of a factor is China and our talks with China?
Great question. So first of all, one of the irritants clearly is dealing with dairy, but I do think that dealing with some of those issues in our the way in which we deal with a market, there are ways to approach it. China, and it's really interesting, is today the foreign minister of China happens to be here in Ottawa, and I think it's important to recognize that Canada can be a very important vehicle also with for the United States, but working with the United States to address China issues. I mean, our trade with China, first of all, is 1/10 of what it is with the United States. There's no comparison. And let's remember when it was Pierre Trudeau that went to China, effectively opening the door for the United States to then enter into their relationship with China. So this is why we work well together. When we put our minds to it, we're far, far better than the sum of our parts when we work together on that. And we can help make America great again. But it's a question of how the Americans look to us and how we sit down with them to address global issues, while we also work very hard to diversify our trade. There's no question Americans are better off if we're also strong in terms of our economy. We have countries that we work with that then maybe, make an investment in the United States, hear from Canada. These are all very exciting moments in terms of being able to look at it. If we look at it positive and we understand really the geopolitics of the world, in fact, oblige us to work together and recognize the value of our partnership as we have it.
And is there a real danger that if this drags on and we don't have something a little solid by July 1st, that the U.S. companies down in the U.S. start looking and going, you know what, we're figuring out ways to adapt and not need the Canadians, and maybe we don't get that business back even if we do get a deal?
No question. That would be a sad day, because I think that it would not be easy for them. It would be tough for us. And there's no doubt. I mean, our numbers today demonstrate that, we're not doing as well as we would like to. As we see, we can see interest rates rising. That would not be a good thing either. But they'll feel that in the United States as well. I mean, there are certain things that they don't have that we do have. First of all, the ability of us being able to work on the energy front. When we look at the opportunity there, which is incredible. Critical minerals. You remember we had a few months ago this whole issue with respect to potash. The Americans don't have the potash we have. So it would be very difficult to get that. And actually, while we are working right now to invest in mining and being able to get at those critical minerals, far better for the Americans, I like to say our cousins, to get that from us rather than try to get that from China and elsewhere. So it's a question of how we work together. There's not a lot of logic if we actually don't do that.
All right, I got to wrap it up there, Jacques. We could talk much longer on this, but always appreciate chatting with you. Thanks for joining us.
Such a pleasure. Thank you, Roger.
Jacques Shore is Government Affairs and Trade Partner at Gowling WLG. Coming up, we'll look at 3 hot picks in the tech sector when we come back. Time for hot picks, and today we're looking at the tech sector. For more, let's bring in Jed Ellerbrook, Portfolio Manager at Argent Capital Management. Jed, thanks very much for joining us.
Hey, thanks for having me today.
Okay, Microsoft showing up for you. What has your attention there?
Yeah, Microsoft is a beaten down stock over the last year. It's been caught up in a lot of the software disruption from AI fears. And I think that's unfounded. And we've actually seen Microsoft stock rebound here and perk up over the last month and a half. We think Microsoft is an attractively priced stock, just a hair over 20 times earnings, which for it is on the low side. And I think that they're infusing AI, tools and functionality into a lot of their software products, which is going to make them more relevant for customers and help to continue their growth alongside Azure, which is their cloud computing unit, growing about 40% a year and speeding up here in the next couple quarters. So I think there's a lot of good news. I think Microsoft has deeper ties with its customers than just about any software company in the world. And so we think that they are a software winner. And we think investors are starting to pick through the rubble that has become of software in the last 6 or 9 months and identifying stocks that are going to be attractive going forward. We're seeing that this morning with Okta, which reported results yesterday afternoon.
Any concerns with Mark Zuckerberg's comments that maybe they might be getting into cloud wars with Amazon and Microsoft? He said, what's the quote? It's definitely on the table.
Yeah, it's a really big ocean. Cloud computing, the demand for those services and tools is exceptionally high today. There are a lot of neoclouds that are jumping into cloud computing. SpaceX is rented out some of their AI factory capacity to Anthropic recently. So no, I think right now there's more demand than there is supply. New entrants are coming into the cloud computing industry, but the big boys, Amazon's AWS, Microsoft's Azure, Google's GCP, are in an exceptionally strong competitive position.
They know how to play. And software, the death of software greatly exaggerated?
In some cases, yes. I think there will be, software businesses that struggle to grow in the future as they have in the past because their use to customers is surpassed by new AI functionality. But there are also a handful of software companies, and probably more than a handful, that have very, very strong growth prospects going forward and are going to adopt AI tools, improve their products, and become even more useful for customers going forward. So I think it is going to span the entire spectrum.
All right, let's move on to TransDigm.
Yeah, TransDigm is an aerospace and defense company that has really all parts of their business, all parts of their customer base growing strongly. The defense business is growing. The U.S. Department of Defense budget continues to grow at a high single-digit or low double-digit pace. That's been helpful. And then commercial aerospace is growing strongly as well, both new equipment new plane shipments from Boeing and Airbus, and then also the aftermarket business sold mostly to airlines. Those are both growing double digits as well. So all customer groups are firing. They also have been doing acquisitions recently, which are contributing new growth to the company. And we think the CEO, who's about at the 1 year mark, is off to a good start in his tenure.
What are some of the acquisitions they picked up?
Yeah, they bought a couple companies out of California. Sierra is the name of one. They're companies that do aftermarket parts mostly for airplanes. So, that aftermarket business is appealing because the products usually are sourced from only one or two competitors, which gives the supplier, TransDigm in this case, or the companies they bought, good pricing power and also the ability to, project demand forward years in advance with high likelihood.
And does it almost put them into a silo?
It does. Yeah, the aerospace and defense business is extremely siloed product by product, which limits competition within each silo. That's why you see a lot of successful aerospace companies making acquisitions and kind of consolidating the industry. HEICO's been very successful doing that, dozens and dozens of acquisitions over the last year. TransDigm is another group in that category as well.
Okay, and last one we want to get to, Broadcom, the earnings are coming out. It's another one I think people are going to be paying attention to.
Yeah, huge company, huge earnings report coming next week on Wednesday afternoon. Demand for accelerated computing is exceptionally high. We saw NVIDIA's results 2 weeks ago. They're obviously the market leader, but Broadcom and their kind of customer chip efforts are doing very well too. They're the primary supplier behind Google's TPU. They're also working with Meta and OpenAI and a couple other companies to develop their custom accelerator chips. Demand is extremely high. Those customers are placing a very high priority on the internal development of those products with Broadcom's help. So we see exceptionally strong demand. And then, of course, they have, the other half of their business is software, where I think we are seeing sentiment improve. Broadcom stock has done pretty well lately. It's at an all-time high, but I think it's still reasonably priced. Investors have been more excited by other, kind of racier semiconductor stocks, memory, and also recently some of the edge hardware companies. So while semiconductors have been doing great, Broadcom has actually been lagging the group, and we think is a pretty attractive candidate to buy today.
And what are you going to be looking for in the earnings to maintain that optimism?
Yeah, their guidance for next quarter is going to be big. They'll tell us more about TPU ordering plans. Google is now selling those chips directly to customers. And so I think that's a big new step up in demand coming here over the next couple quarters for Broadcom.
And any concerns with AI right now, or does it seem like it's settling in and is real?
Yeah, demand remains quite a bit higher than supply. And so it's all systems go across really the entire supply chain. NVIDIA, of course, leading the way, but so many others at this point following.
All right, Jay, we got to wrap it up there, but thanks as always for joining us.
Have a good day.
Jed Ellerbrook, portfolio manager at Argent Capital Management. Coming up, oil inches lower on optimism over the U.S.-Iran ceasefire. We'll hear from the Chevron CEO on the state of the global energy markets. That's after the break. Oil is feeling some pressure this morning as investors turn optimistic on prospects of a long-lasting ceasefire deal between the U.S. and Iran. Earlier, Bloomberg spoke with Chevron chair and CEO Mike Wirth, who talked about the impact of the war in Iran on oil prices and global supplies.
Markets tighten, inventories draw, demand for products around the world still very strong. I think there's this belief, and we're experiencing it again the last few days, that the end is near, the conflict is nearly resolved, and flow through the Strait will resume very quickly, and that has kept the back end of the curve lower than it might otherwise have been. And I think the psychology of the market has been this is closer to the end rather than the beginning.
But what about the physical world? When will inventories be at the very bottom?
Before long. We are steadily drawing inventories down on products, on crude, in locations around the world. I think June and July are going to be critical months, and you can see the trajectory of these inventories in the data, and it's concerning.
Do you see any physical shortages right now around the world?
We do see some in some Asian markets, and we've seen some rationing. We've seen work weeks adjusted, other demand measures imposed in some of the countries in Asia. Markets are very efficient at moving products and barrels to where they're needed, and we haven't reached a crisis point yet. But the inertia in the system is very, very strong, and turning that is not easy.
One of the main sticking points the U.S. has when it comes to negotiating with Iran is this idea of the tolling. Would Chevron consider paying a toll?
No, we wouldn't.
Do you know how people are paying a toll?
I've heard reports of people using cryptocurrency in various countries. I think the Treasury has come out this week and sanctioned the new authority that has been put in place to oversee transit through the Strait. It went from a toll to a navigation fee to something else.
Would you pay a navigation fee?
A carbon tax, I don't know enough about any of these things to say definitively. But look, freedom of navigation through international waterways is a very well-established principle. And anything like this would begin to say that countries adjacent to an international waterway can charge some sort of a transit fee. There are many other places in the world where that principle could be applied, and not just to energy products, but to all freight moving through the Straits of Malacca, the Bosphorus. Pick your choke point, and so that's not a principle I think that most countries in the world would find acceptable.
How far are we away from having pipelines that connect some of these countries to the mainland and their production without having to traverse the strait at all?
Well, there's a couple that exist now that you've talked about in Saudi and the UAE. The UAE sanctioned a project last year, which is about 50% complete, to get more of their production over to Fujairah and outside of the strait. So I think you'll see more of that, Lisa. The one opportunity there is, countries like Iraq and Kuwait that are deeper up in the Gulf don't have access to those pipelines. And for them, the route could be through the north and ultimately then into the Mediterranean, maybe through Turkey, where we see a pipeline comes out of the Caspian Sea over into the Mediterranean in Turkey. And so I do think one of the responses to this will be infrastructure investments that will allow these energy flows to avoid the Strait of Hormuz. And that's underway now, and I think you'll see that in the years that follow.
We started the conversation talking about why oil prices aren't higher, and you saying that we're getting close to breaking the bottoms of some of the inventory bins. And we were speaking just a moment ago with Alex Altman at Barclays, who said we actually could see a glut of oil in 6 to 12 months' time if there is a resolution here based on the production levels of so many different oil companies and countries. What's your take on that? Do you think that that's a feasible interpretation?
Well, history says that shortages tend to be followed by gluts, and high prices send a signal, and markets work. Consumers consume less, producers produce more in response to a price signal. And there's a time lag in the way both of those manifest themselves in the market. And what has happened historically is about the time that the new supplies reach the market, demand may have turned down through conservation measures, economic slowdown, maybe a recession, and you can see those lines cross over and the price cycles down. It's why commodity markets are cyclical, is they tend to overshoot. And, history says when we get into one of these situations, that is somewhere out in the future.
What signal do you take from the futures curve? I'd love your reaction to that, because so many people have pointed to the back end of the futures curve as a prediction of markets of where they think crude will be. How does an energy boss like yourself look at the futures curve?
Not very frequently. It's not something we use for planning purposes. We do a certain amount of hedging in our business on commercial activity where you will use futures, but we don't look at the futures curve as a prediction of future price. We do our own fundamental analysis on demand, supply, technology, policy, economic growth, and arrive at our own scenarios. And we don't use a point forecast or a curve. We use a range of scenarios. Prices are hard to predict in these markets, and so we don't anchor on a single price. We use a range of prices.
And that wraps up this edition of The Open. Morning Markets is up next.